Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City, and I am here to bring you a quick review of the trading week ending September 22nd, 2023, and then we'll also talk about some trading levels that are in place for the upcoming week of September 25th, 2023. So taking a look at the chart here, we're looking at the SPY, which of course is the S&P 500 ETF. This is a daily chart here. So this is where we finished on the 22nd on Friday. So we're sitting at roughly about 430 here. We're basically in the middle of kind of a move down here for about the last little over a week. There's been a thump down ever since the 15th of September, the prior Friday. So we can see we've dropped here from more or less over here, that prior local high here, and we're now pretty much sitting down here. So from this blue circle, which is where that local high was, we're down about 4.5% from that local high. And then if we actually look further up here into, let's say, earlier in this summer, we had hit the 52-week high on the SPY a few weeks before that, and we're about 6.5% down from that. So in context, that's where we are now. And again, there's a little bearish sentiment in the air and concern about yields and the bond market. So at any rate, that's where we're sitting right now. So what I want to do now is kind of look at some trading levels for the SPY, a couple of other of the major market indexes, and then we'll also look at a couple of popular symbols. Before I do that, though, of course, I do want to just bring up the ubiquitous disclaimer. Precision Trading Labs, we are not money managers, we are not financial advisors. But we are presenting everything here for informational and educational purposes only. And if you decide to obviously trade based on any of this, obviously, please do that with responsible risk management. But again, this is all for educational and informational purposes only. All right. So let's take a look at some of the charts here. So again, here's where we are on the SPY here. Right here, just a bit below, we actually have what we refer to as a demand zone right here. This is an area, and let me just spread this out a bit. So right here, we have an area of there was consolidation here. Obviously, price went sideways here for about 3 or 4 days here, and then price rocketed out of there from there. This is an area right here that represents where basically buyers and sellers were in balance, they were in agreement, but then essentially what you had here was an exhaustion of sellers. The sellers were no longer willing to sell at this level where they were 3 or 4 days prior. And the reason these trades occurred, of course, is that the buyers ran up the price chart until they can encounter willing sellers. And so we think of willing buyers as demand for shares and willing sellers being the supply of shares. And so right here, supply and demand were in balance, and then they went out of balance when this happened here. Essentially, the sellers backed up the price chart. Again, the buyers ran up the price chart in order to meet them. And so what you had left back here now, once that occurred, was only demand. There was no supply left there was no supply left because essentially they ran up the price chart. So we refer to this as a demand zone once that exhaustion of sellers occurs. So when price comes back here, because it was in here for a relatively brief amount of time and this left with a great deal of energy, we have the expectation that we can see another bounce out of here because the price has not been back here since. Okay, so when SPY returns back here, this is a place where we would expect to see another bounce. If we look here, that's less than 2 points away. Okay, the SPY closed around 430.5. Okay, this is at 428.5, so this is about $2 down. And so we can see we're a very short distance away. We're less than 0.5% away from here. Okay, so this is an area where we could expect to see a potential bounce with the SPY. Also, in looking at the chart, We also see that we are right at the right at the lower Bollinger Band on the daily chart. Okay, so that indicates, of course, there was 2 standard deviations down from that 20-period moving average that is utilized to construct the Bollinger Band. So that's an indication that price is very stretched to the downside. And so that's another thing that kind of feeds into this trade. And then lastly, we can see, looking at the slow stochastic here, we are also oversold. Okay, so when we combine these 3 factors, we're at a quality demand zone, we're at the lower Bollinger Band, and we have an oversold condition. Those are 3 factors that there's what we refer to as a confluence, where those 3 factors combined suggests that this could be a strong a place where we could expect the bounce. And this would be a high probability trade over here. So that's the story with the SPY here. Similarly, up here, if we look above, if for some reason we got a rally, let's say immediately off the bat tomorrow, and it never got back to this demand zone, but if this thing just kind of started to sort of drift upwards, up here, this is a supply zone. And this is the same narrative of what I just described over here, except, of course, inverted, in which case over here, you had an area of consolidation. Right here, you had that thump down, another gap, a gap, and then another bearish thump down. And again, this little area of consolidation in here with these kind of indecisive green candles here. Right here, this is indicative of an exhaustion of buyers. Okay, right here we had an exhaustion of sellers. Here we have an exhaustion of buyers. Okay, so right here, the supply and demand were in balance. And then right here, essentially, what happened was that the buyers were no longer willing to buy at this level. And so essentially, they backed down the price chart. And so the sellers had to run down the price chart until they can encounter willing buyers. And that's how these trades got created. Again, when price returns to this level, the same exact narrative of what we said here, except again on its head, is that when price returns back here, we consider this to be a level where we could express a bearish trade. Okay, the SPY has not been back here since this got created a few days ago. So this is what's referred to as a fresh supply zone. And so when price returns back here, this is an area where, again, we could express a bearish trade. Okay, so that's what we're looking at here on the SPY here. All right, and again, there's your explanation here. Okay, and again, just to reiterate, so we have, this is an area of expected future downward price pressure, and again, it's created by this consolidation in a tight range, then a clear abrupt exhaustion of buyers. Okay, and then again, this energetic bearish move that kind of goes a long distance. And those are the 3 major factors that characterize this supply zone. All right, so that's what we're looking at on the SPY. If we take a quick look at the Qs, which of course is the Nasdaq 100, the Nasdaq Composite ETF. If we take a look at that, we can sort of see relatively a somewhat similar pattern here, but it's not quite as distinct or nice. The supply zone looks exactly the same pretty much as the SPY. Down here, this is a little less clean than we saw on the SPY. Having said that, if we get a pullback here, and particularly if we start to see a bounce on the SPY, we're going to pretty much see that same move probably mirrored here in the Qs. So even though I'm not necessarily in love with this level on its own, the fact that it kind of it's more or less in line with the and sort of in the same position as the SPY, I would expect we're going to see roughly that same kind of reaction. If assuming that the other level works, we will see that similar reaction here on the Qs. All right, and again, it's the same exact thing: a supply zone there and a demand zone there, and of course, then further down, there's another. This is the next quality demand zone down, and of course, so after this level, if this level would happen to break, then the next key trading level we would be looking at would be here. And of course, that's a much further, obviously much further down, because this other one is about 1% down, and this, of course, is quite a ways down. So if one's rooting for the market, let's hope that we're not going to be testing this level at any time soon. Okay, but at any rate, that's the story with the Qs. I'm also going to take a quick look at the bond index here, which is the TLT, and of course that is the ETF of the longer term bonds, which are the 20-year duration and beyond. So here's what we're looking at on the bonds. We're actually at a multi-year low here. Obviously, with the Fed raising interest rates, with yields going up, the bond prices, of course, are inverse to that and going down. So we have not been back to this level in several years. So I'm not racing to find a bounce here. But however, if this thing rallies up just a bit, right here, there is a supply zone right here. And so this is, again, where I would be looking to express some kind of bearish trade. And when I say express a trade, obviously we could simply short the TLT here, but the other ways of expressing the trade, of course, would be to buy a put. One could also do a bear put vertical debit spread. And then, of course, one could also do a bear call vertical, before a bear. Let's try that again. We can buy a bear put vertical debit spread here, and then we could also sell a bear call vertical credit spread here in order to collect premium. So those are all the different ways of expressing a trade at this same level. And I'll kind of list that in the next chart when I go into a couple of the other symbols here. But anyway, that's the story with the TLT. So let's take a look at a couple of other popular symbols that people like to trade. So let's take a look at Google here. So here's a chart of Google. And the thing that I did notice about that, I actually was not in love with this chart when I was first looking at it in terms of just the pure supply and demand. However, there are a number of other things going on. I thought I would just kind of point this out here. Right here, this is an area over here. This is really not clean. There's no clean demand zone here. There's a 2-hour level in here, but you can notice this is just sitting nestled in the middle of all this mess here. And generally, I'm not a huge fan of this. The one thing I do notice here, though, is in addition to this is what I would consider to be more or less an area of support. It's really not demand here. But if you notice right here, we've got this is the 50-period simple moving average right here. This is also sitting at its daily lower Bollinger Band. And again, this thing is oversold. And again, it's at an area of support. So I'm going to be watching this level, even though, in fact, from a pure supply and demand level, I'm not really in love with it. The fact that you've got this confluence of all of those four factors that I just mentioned, I think that this is a potential level that if it drives to it, if I'm going to be watching to see if we can get a bounce out of it. And if there is some confirmation that there is starting to be a bounce coming from this, I would then express some kind of bullish trade. But again, I think I'm going to wait to see if in a lower time frame if there's going to be some kind of a reaction before I would just automatically put on a trade when it gets to the front door here. All right, so that's the story with Google here. And then up here, this is a supply zone that's sitting here at around roughly the 137 to 140 range right here. And again, that's also in the vicinity, of course, of the 52-week high here. And that's what that blue cross is. All right. So that's the story with Google here. Let's take a look at Netflix. Again, we're looking at the daily chart of Netflix. Here's where we closed at approximately 380 on Friday. So a bit down from here, from 380. The next clean demand zone here is below here, and that's about 4% down. So you'd need to see about 15 points come off of Netflix in order to reach this. Having said that, if you see 15 points off of Netflix, that's not exactly that would be what is that, approximately about 2%. So excuse me, 4% here. So one could see that coming off there, and at which point then this is where we could express a bullish trade. So again, we mentioned, how do we express a trade here? So again, we could buy the stock, we could buy a call, okay? And by buying the call, what we would do is buy something that has a strike price, probably just a bit in the money. So probably, let's say buy the 350 or the 355. Okay, and if this thing is sitting at 364, we would be obviously about $9 or $10 in the money here. And then we would buy it about, let's say, 3 months out or 4 months out, so that we're not going to get too beaten up by time decay there. Okay, but the other way one could express the trade, in addition to the highly positional trades of buying the stock and the call, is to also put on a positional trade, but one that's a little less positional, in which case what we could do is do a credit spread. And what we could do is do a bull put vertical credit spread here, and by selling a put behind the demand zone, and then buying a put further down in order to control and define the risk. Okay, and so that would be another way of expressing expressing a trade from this demand zone here. Okay, so in fact, one of the things I was actually looking at here was selling the October 20th bull put vertical credit spread, and that's approximately that's about 28 days till expiration. If we look up here, we can see that the next earnings announcement is actually on the 18th, so that would actually be 2 days before the expiration of this option. So depending on where we were sitting, I would either close the trade, let's say close the trade right before the earnings announcement, in order not to have to gamble on the earnings announcement. But I would, of course, wait to see, where this thing, where the price of this was sitting here. So assuming that we get a bounce out of here, if we did that credit spread, obviously then that credit spread would start to erode in terms of its value, because of time decay. And of course, given that we're on the sell side of that, we are, of course, winning from time decay. And so that's the whole thesis of that trade. Also, one could look up here, and the other thing one could do, and this would be a very high probability trade, is you would collect a lot less premium. What you could do, though, of course, would be to sell a bear call vertical credit spread. And what you could then do here is, if you could sell, let's say, the 455, you buy the 465 above, you do that at 28 days out. You would collect approximately, at least the last time I was looking at it, it was approximately about 70 cents or something along those lines. So you're not collecting a tremendous amount of premium, but on a 10 lot, that would, of course, be $700. And you would, of course, monitor your risk on that. But the point being is that this would be a very high probability trade, because this thing would have to rally all the way back up here and then actually violate this supply zone. Okay, and this supply zone would actually be protecting the short strike up here. If we use the 455 short strike, okay, you can see that this supply zone ends up here. So this essentially acts as a shield. And that's one of the ways that we actually construct credit spreads, by utilizing these levels as shields for short strikes. And that's actually highly effective for us. So that's another trade you could do. And then also, for those of you who are experienced with credit spreads, if you start thinking about this, well, if you happen to think about putting this one on, okay, and you put on the bull put vertical spread, okay, the vertical credit spread, and if you happen to do the same thing on top, and you slam them together, well, then at that point, now you've got an iron condor. So that's another thing that you could do. Okay, so you could basically sell this one up here. Again, I think you collect about 60 or 70 cents up here. Down here, you would collect approximately about $2. And of course, reason being is that you're much closer to the money here. Or, in the sense, you're much further you're much closer to being in the money here than on this other one. And so, of course, you would collect a lot more premium down here. So combined, though, this would be a value of about 270 if you would actually do the iron condor here. So again, you can do each of these individual credit spreads, or you can combine them. You can combine them, and you could do both of them. And at that point, there's an iron condor. All right. So that's Netflix. And then lastly, let's take a quick look at Tesla. All right, so here's Tesla. We are kind of sitting right in between these levels here. So there's a good demand zone here. Up here, there is a supply zone. However, this supply zone one would have to actually drop this thing down to a 2-hour chart. You can see that there's that overlapping body and wick here. So there's nothing really clean in the daily. But if we drop this thing down into a slightly lower time frame, into the 2-hour chart, we would then see that, in fact, there is this reversal right here. So notice price drops in here, and then notice we had this bullish green candle here. In fact, let me just blow this up a little here so you can see it better. So right here, price drops here. Then notice we had that pop with this green candle, and then with this little consolidation, and then we start to head right down from there. So in the 2-hour chart, this little kind of almost pivot in here, this would be an area that we could expect. We can construct a bearish trade out of this supply zone here. Okay, and so that's about 5% up. So that's a fairly that's a chunky move. But if we do get a rally up here, which is about 12 points above where we are now, from going from about 245 to about 257, this would be the area that we would express a bearish trade for Tesla. And then similarly down here in the daily chart, this is the area where we would express a bullish trade. And again, we could also, in addition to the debit structures where we either buy the stock or buy a call, one of course could also again do the bull put vertical credit spread. In other words, if you're not necessarily confident that you're going to get a big pop out of here, all you'd have to do is have this thing stop the descent in price, okay, and just sort of keep it at bay, or even just have it drift up a little, and then at that point, then you would be a winner. As you get closer to expiration. All right. So at any rate, that's what I got. So I hope everybody found this interesting and informative. So again, this was all about identifying quality supply and demand zones, and then utilizing those as the basis to create high probability controlled risk trades. And if you found this interesting, I would be delighted to speak with you further about this. And so if you look in the description of this video, you'll see that there's a link where you can set up a call, and I would be delighted to take a few minutes and talk to you further about this. All right. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs. Thank you for the privilege of your time, and I will see you next time. Take care. Bye-bye.